Hey guys, it's October the 18th, 10/18, such a good luck day. Maybe that's why the markets are up despite some really questionable earnings out there. Now, I just want to tell you, I am closing in on having listened to about 50 calls, and this earnings season is definitively worse than the last earnings season. Last earnings season, no matter how many calls I listened to, it was about 57% were positive, 43% were negative. Right now, we are more or less at 50-50 given the hour or the day that I've listened to it. And the ones that are bad are really bad. So I have no idea why the market's rallying other than like technical stuff, conspiracy theory stuff, which quite frankly, unfortunately, you can't completely ignore given that there's so much of it right now. You've got the CCP and China, you've got our own elections, you've got whatever is going on. But let's go ahead and take a look at what we're seeing today. I'm going to share my screen. Past performance is not indicative of future returns. What I'm going to do today is I'm going to go briefly through and walk through pretty much all the earnings reports that I haven't talked about yet. I've been doing this every day, so definitely subscribe to my YouTube channel so that you can check out what we're doing here at Gurula Markets with May. Yeah, so we've got all the indices up. Now, they were up even more aggressively on the open, and that's despite the fact, you'd almost think up is down and down is up in this marketplace because given how some of these companies reported, it makes no sense that they traded up the way they did, except if you have some crazy short covering. But even then, these are bad. So, here's the indices up 1%. It's within the range of standard deviation because now I think if you annualize out what we're seeing, a 1% move is just a normal move for the S&P and subsequent indices. Oil down again. This is slowing global GDP, which is nonsensical. But what I find really nonsensical is the way Europe keeps trying to rally, because let's call it what it is. This is the only thing that might help them. This kind of weird manipulation of the oil markets, it's the only thing that's really going to help them in a meaningful way. Now let's talk about FinViz. Let's take a look. I'm going to refresh this just in case. Big fan of this piece of software or website. This is the free version that I'm using. And you can see it's very much so a mixed bag. A lot of this is just setting up for, I think, what will be a very mixed, intriguing earnings, and you should take advantage of it. I will highlight CRM, which I have been a bit bearish on, up 4% today because of an activist. Let me explain to you what an activist is. An activist is someone that buys a company because they think it's poorly run, okay? So it usually takes them 6 months to a year to get their way. So let's not be confused as to what it means for an activist to be in CRM. It is not a positive. It's an affirmation that somebody else sees it the way I do. Definitely check out my episode on CRM if you're confused as to why I see it that way. But, that's how I'm looking at this. But nonetheless, the market would like to trade it up to 4%. I don't think they conceptually understand what an activist is my opinion on the matter. Okay, now let's talk about what's going on. Economic data, industrial production came up better than expected. Now, these numbers have been all over the map. So we really need to see more than one industrial production-esque, whether that's PPI, whether that's a couple of things to really make sense of any of these numbers. But overall, we at Gurula and Markets with May have been saying that there is a possibility that the weakness in Europe, which is why Europe should not be rallying on any given day and makes an excellent hedge. But the weakness in Europe, due to the fact that their oil and electricity prices are going up, will make them less competitive relative to US manufacturing. And for better or for worse, that's just a statement, let's call it. You can agree or disagree. And whether or not global GDP is going to, like, where all of these little variables match out is another story altogether. But this number, bright and early at 9:15, may have been what sent the markets straight up because earnings surely did not. Now let's go through them a little bit. Hasbro, don't be confused. That was not good. Down 15% on top line, down 47% on operating income. They made none of it back. So every single bit of this loss dropped straight down to the bottom line. The only thing that is even saving them is they have a couple of possible movies that they're licensing out that they think might be great winners. Otherwise, there are some real changes that are going to have to happen at Hasbro. And right now it still trades at 3 times book value, which is the way that I think people need to start thinking about this company because they haven't been able to get any lift on this. And I don't see given the mix of what's going on there, sorry, I didn't pull it off, but they weren't even able to make money off the gaming component of their business, which does incorporate the video game stuff. Video games have been so weak in general because of what we're seeing across last quarter, but what I suspect we'll see in this quarter. This is just something special that the market doesn't want to slam it down more. Now, some people might say on valuation, maybe we're really talking about 7 times, or enterprise value EBITDA. And I'm like, you just missed earning, you just are down 49%. That's probably a stale number. Nonetheless, that's Hasbro. The banks, this is just some cleanup from yesterday since I've been a little bit under the weather. They're mixed. Bank of America was great. PNC was decent. I'll also mention that there were 1 or 2 other banks that were good. Regions was kind of mixed. Regions comes out, I'm sorry, not Regions. FRC, the one here in New York, they did great, but they got clobbered for it because they came in just a little bit less than net interest margins. I think that's unfortunate. Bank of New York, not great in my opinion. And Truist, he's going to basically take a kind of ballsy strategy. Was a weak quarter, but you know what? I kind of give the man credit because what he's decided is that he's going to buy companies. He's not going to wait. He's just going to go ahead and use capital to buy companies. Now, this could work. This could not work. I think he's a little bit early. I think he should chill out for literally 1 quarter and he might have a better situation going on. But nonetheless, he went ahead and borrowed from future earnings to go ahead and continue his acquisition stream of things going on because of what he's seeing in his business. So I'm going to say it's weak-ish because that's why it came in the way it came in. Goldman Sachs. This was not good. Not good, guys. Okay, so I have no idea why it's trading the way it's trading. You had revenues down 26%. You had no change in provision for credit losses. So they're right at where they're supposed to be at. And then you had earnings down significantly, 45%. Okay, 44%. And the thing trades up 5%. Look, I'm a huge fan of Goldman Sachs. The thing is at about 1 times book value right now. I get it. Is that historically cheap? You know what? When I actually thought things looked a lot better for them, this thing traded below book value. So at 1 times book value with all this other stuff happening, and we still don't know what's going on with the mixed bag that is European banking, I'm not convinced. I mean, the VAR on this actually ticked up just barely a hair. And in fairness, Goldman does run, I've said it over and over again. I'm on the record many, many times saying that Goldman definitely has one of the best risk management strategies all around. But I mean, this ugly environment. I don't understand. I don't understand like why you would then give it more value versus less. I mean, I feel like the market should at least wait until bank earnings come out from Europe next week and we actually get a sense for whether or not someone's holding the bag there. Additionally, Lockheed Martin, despite the fact that they are benefiting from this terrible situation that we have globally with defense spending up 5% around the globe, this wasn't a good quarter, okay? It wasn't. And the only way that they made this really positive earnings was because they had a one-time expense for pension funds last year that was pretty dramatic. Now, let's just talk about that for a second. So basically, they had this little expense of 111 versus a big clobbering last quarter to get the pension in a certain state of affairs. But let's be honest, the market's been down like over 20%, unless these guys did the most brilliant thing, which is jam everything in a fixed income at exactly the right time. I don't buy it. I don't know another way to say it. And so, it's just bizarre. They do benefit, by the way, and we did find out here, in case it wasn't something that you've been watching, that we are, the United States, going to put in about $9 billion worth of funding into the war in Ukraine. I don't know that that's on everybody's radar screen, but it was something that was a little bit news to me. JNJ, one of the few that reported a decent quarter. And just to give you a sense for how decent this quarter really was, I want to show you how much they lost. Oh, sorry. I didn't put it on here. Yeah, here it is. Okay, I want to show you how much they lost on currency. All right, they're taking like 12% hits on that. And so as a result, the international business was a bit weak, but 12% because of currency on a blended basis, 6.2%. JNJ actually sold volume. Okay. Everybody else is going to have to do approximately the same thing, because this is probably not so different than what everybody else is going to have to demonstrate on the quarter to show good earnings as we move into the latter part of this month and really get these people coming clean. I don't love that going in. State Street, I haven't had a chance to listen to them yet. That was a bad quarter. State Street really tells you, because State Street does own the S&P indices, in the sense that they own the data portion of it, they get royalties on that. That has been money just coming straight out of their pocket. So this has not been a quarter where I'm like super thrilled to be like, it makes sense that the market should rally. I actually think that if anything, the market should calm itself down a little bit. But, to the extent that it let some people re-hedge their book, or it let some people out of trades that they didn't want to have, I think that's awesome. And so with that, I'll stop sharing and take any questions. How's it going? Oh, you know what?
China. You had mentioned China was a big factor. Can you briefly go over that, please?
Yeah, sure. China, actually, you've got a trade on and I've got a trade on that's kind of China-esque in that regard. In that regard, you're a permable on Tesla, which I totally appreciate. I actually think that it's been strange that the fundamental people who have been so negative seem to have disappeared one way or the other, and seem to have ignored what has actually been accomplished at that company over the last 6 months. So I'm not in any way controverting the bulls on Tesla, despite the fact that I wish Elon would just chill out sometimes, you know what I mean? But my bet on China is actually MGM. And I do it as a calendar spread. This morning I lifted parts of it. I just moved back some parts of it so that I could have a better, well, sorry, I actually don't have it as a calendar. I have it as a diagonal. But so I adjusted my diagonals a bit. But MGM, Tesla, there's a few others that really benefit on a China reopening. And we won't, there are some initial news flows that you're seeing in various publications on how to think about China and what's already come out of the CCP. In theory, they haven't done anything on COVID. They're going to continue to call it a success and all that stuff. But just like anything else, and as you can imagine, very Chinese culture, for those that are still learning Chinese culture, what we first do is we confirm all the things that have been done in the last 5 years and talk about why they're a success. And then slowly but surely, any alleviation will slip out over the subsequent weeks, months, etc. So the timing is, to me, a little bit difficult to say. I think we'll get evidence of it slowly but surely. The fact that there are still issues with Taiwan and Hong Kong make it very hard to figure out how to think about timing. And then we ourselves have our own elections over here that make it, it just, let's not be confused. We do the same playbook that everybody else does when the economy is weak, which is we talk crap about other countries. And so China does it. That's why they launch missiles at Taiwan half the time historically. Okay. I'm not making a comment about what's going on right now, right or wrong, but we do it too. Okay. No one is absolved of this. All nations have done it at different times. It's really hard with how much is going on in the elections front to make sense of this geopolitics. And as such, I think you just got to be really cautious in the way that you structure. You really do want to use the options market to take advantage of the vol. That was a really long explanation for your really short question.
So, but if China does open up, it helps Europe, right?
Yeah, 100%. It will help Europe first more than anything. It'll help Europe even faster than it helps us, because for us, it's unclear whether, well, I shouldn't say it's unclear. We got to get this port thing under control, right? A lot of the issue that we had almost immediately out of COVID was, even if you could ship it from Asia, all of Asia, Vietnam, Southeast Asia, they're also big producers of stuff, but it all comes across to the West Coast. And, there's been some you're actually probably better than me at being able to say what's been alleviated, because you're sitting right there on one of the ports that needs to figure itself out. But as a result, that's been a problem for all the Americas. And then as relates to Europe, because of Belt and Road, it's not nearly the same issue. Plus, there's a number of things that China could do. They could release nitrogen, they could release coal. I can't see them, as much as I think that it's hurting some of the my mosaic, which I will always be bullish on. I just think that it's very misunderstood. I don't see them releasing potassium in the same manner because they actually just don't have as much of it. Nitrogen, they definitely do have plenty of it. That's in the disclosure statement for CF. It's part of the reason that even though I'm very bullish CF, I do have to be cautious until we get a better sense of what's going on in China.
Got it. Thank you.
Yeah, but the potassium shortage is real. And just think of it this way, it used to be, before China decided no moss, we're not exporting potassium, which happened, by the way, in the fall months, November, December of last year, that Australia would get 60% of its phosphate potassium from China. And China was just like, no, thank you. And so that's kind of, there's massive demand. Now, we don't necessarily benefit from that because there is shipping costs, but it does mean if you just rejigger where everything needs to go to globally, yeah, I mean, we're more likely in the US, given where our mines are located, to ship it down to like Brazil. And so in a lot of ways, the potassium phosphate situation is, for us, is much more about the idea that given where everything falls out at the timing of the year and what the timing will be of nitrogen release if China decides to do so, it really puts a lot of pressure on South America to be a much bigger breadbasket.
Okay, thank you.
Anything else going on?
Drink lots of tea.
Yeah, I know there's so much going on in earnings. I mean, it is crazy. Actually, I should share that one little thing because we've got some crazy earnings going on. Oh, the one last thing I would mention is Abbott reports earnings tomorrow. And I will be watching Abbott reports earnings tomorrow. Abbott has a pretty good diabetes practice that it's been continuing to do, increasing investment on marketing, that sort of thing. I'm really watching it very closely for some feedback on how things are going for Senseonics, which I am, again, looking at options plays in, namely going farther out like January, et cetera, and seeing if I can get call options on it there. So if you guys want like a lottery ticket type play, I actually think Senseonics might be a place to go, because depending on what Abbott says, and for whatever reason, because Senseonics belongs to the meme guys, and the meme guys don't do research the way that the fundamental guys do, it could be the case that Abbott reports one way or the other and Senseonic does a big nothing. If it does, you might still continue to get opportunities all the way until Senseonic reports. Ticker SENS on that.
Okay, cool.
All right.
Yeah, seems to trade between 1 and 2.
It does. I mean, it will trade between 1 and 2. We like it because we think ultimately someone will buy them out because they do have legitimate growth. And right. I think that they outsourced some of their sales to this company, or actually most of their sales, to a company that's just better at doing it. So it's really about whether or not they've continued to improve their distribution, or I'm sorry, their ability, the supply chain. And I think they have, because we've seen weakness in the semiconductors, which actually should help them out in being able to get one of the components that they were really struggling with. So I'm hopeful that this quarter looks really good for Senseonics, but we'll know from Abbott what's going on in general. It's our first little glimpse of what's going on in diabetes.
Okay, cool. Thank you, May.
Bye. Have a great day, everyone. Stay healthy.